The US dollar experienced a marked decline against major global currencies on Tuesday, as financial markets reacted with heightened attention to an unprecedented move by President Donald Trump to fire Federal Reserve Governor Lisa Cook. Welcome viewers to my channel. Please subscribe, like my video and turn on notifications so you don't miss our next update. This controversial action has raised long-standing concerns about the independence of the central bank, placing the spotlight on the delicate balance between political authority and monetary policy autonomy. The dollar's movement this week underscores the complex interplay of political pressure, economic indicators, and global uncertainty influencing currency markets in the United States and abroad. In currency markets, the euro advanced 0.22% against the US dollar to trade at $1.1647, signaling modest investor confidence in the European currency amid renewed caution regarding US policy. The British pound also gained ground, rising 0.2% to $1.3481, while the Japanese yen strengthened against the greenback, with the dollar falling 0.27% to 147 yen and 36 sen. Similarly, the Swiss franc climbed 0.28% to 0.8032. The US dollar index, which tracks the greenback against a basket of 6 major currencies including the euro, yen, pound, Canadian dollar, Swedish krona, and Swiss franc, declined 0.28% to 98.19. The dollar's softening reflects investor caution amid heightened political risk in Washington, alongside concerns over the potential direction of U.S. monetary policy and its broader implications for global markets. The controversy surrounding Cook's dismissal began with President Trump's announcement that she was being removed over alleged improprieties related to her mortgage applications. While Trump presented the action as an effort to maintain accountability, legal experts and market observers quickly pointed out that the president's authority to fire Federal Reserve governors is limited under the Federal Reserve Act. This statute grants governors 14-year terms specifically to insulate them from short-term political pressures, a structural safeguard designed to uphold central bank independence and market confidence. Cook promptly responded, asserting that the president does not possess the legal authority to remove her and that she would not resign voluntarily. This standoff raises serious questions about the limits of executive power and the legal precedents governing the U.S. central bank. Despite the high drama of Trump's announcement, market reaction was relatively measured. Analysts suggested that investors are weighing the potential risks of political interference against the possibility that the move could signal a more accommodative monetary stance from the Federal Reserve. Investor activity remained relatively subdued as attention stayed focused on the aftermath of Jackson Hole and the overnight news highlighting a heightened threat to Fed Governor Cook, and, more broadly, to the independence of the Federal Reserve, said Yuto Shinohara, senior investment strategist at Mezero Currency Management. Shinohara noted that the dollar's weakness reflects both the uncertainty surrounding Trump's unpredictable actions and the growing anticipation of a dovish Federal Reserve in response to slowing economic indicators. Recent U.S. economic data provides a mixed backdrop for these market dynamics. Orders for U.S. manufactured capital goods increased more than expected last month, signaling ongoing investment and industrial activity, which is generally considered a positive indicator for economic growth. In contrast, consumer confidence for August showed a modest decline, suggesting that households remain cautious about income and employment prospects despite favorable labor market conditions. This divergence between corporate investment and household sentiment has contributed to the market's cautious stance, leaving traders uncertain about the trajectory of the U.S. economy and the potential response from the Fed. President Trump's scrutiny of the Federal Reserve has been a consistent theme throughout his tenure. He has publicly criticized Chair Jerome Powell for not lowering interest rates aggressively enough to support economic growth. While he has largely refrained from issuing direct threats against Powell in recent months, particularly as Powell's term approaches its conclusion in less than 9 months, Trump's actions have nonetheless heightened investor sensitivity to potential political influence over monetary policy. Historically, the Federal Reserve's independence has been viewed as critical to maintaining long-term financial stability, and any perceived encroachment by the executive branch has typically provoked investor caution. Market expectations reflect these pressures. Traders are currently pricing in an 85% probability of a rate cut at the Federal Reserve's September meeting, according to CME's FedWatch tool. This expectation has been reinforced by statements from Powell and other Fed officials, who have hinted at potential policy easing in light of global economic uncertainty and domestic indicators suggesting slower growth. Morgan Stanley, along with a growing number of global brokerage firms, has updated its forecasts to include a rate cut in September, joining consensus expectations that the Fed may adopt a more accommodative stance in the near term. Expectations for monetary easing remain robust across the front end of the yield curve, following the Conference Board's latest consumer confidence report, which highlighted rising household concerns about employment and income prospects, even as confidence in the business environment showed slight improvement, said Carl Shimada, chief market strategist at Corpay in Toronto. Shimada emphasized that the Fed's apparent shift in focus from inflation toward labor market conditions supports the market's pricing for at least 2 rate cuts this year. This combination of dovish policy expectations and mixed economic signals has added further downward pressure on the dollar. The global dimension of this currency movement cannot be overlooked. While many investors appear inclined to sell the dollar, persistent economic and political uncertainties in Europe and elsewhere have limited alternative safe haven options. Kenneth Brew, head of corporate FX and rates research at Societe Generale, noted that political instability, including ongoing challenges in several European governments, reduces the appeal of other currencies for investors looking to hedge against a weakening US dollar. In France, for instance, government bonds fell as the country's minority government appeared increasingly vulnerable to being ousted, with yields on 10-year French government bonds rising to 3.53%, their highest level since March. This increase reflects declining investor confidence in French debt amid growing political instability, illustrating the global factors that constrain options for dollar trades. The dollar's retreat this week illustrates the broader complexities of the current financial landscape. On one hand, the unpredictability of U.S. political leadership and the potential for more accommodative monetary policy are exerting downward pressure on the greenback. On the other hand, uncertainty and instability abroad limit the range of viable alternatives for investors seeking to reduce exposure to the dollar, creating a narrow window for trading opportunities and amplifying volatility. Analysts caution that these conditions are likely to persist in the near term, particularly as markets closely monitor any legal challenges to Cook's dismissal, upcoming Federal Reserve policy decisions, and broader geopolitical developments. Historical context provides further insight into the potential implications of Trump's actions. The independence of the Federal Reserve has long been considered a foundational principle of U.S. economic governance. Past episodes of political interference, such as criticisms and threats toward the Fed during the 1970s and early 1980s, demonstrated that even perceived pressure can affect market confidence, interest rates, and currency stability. Investors today are acutely aware of these precedents, which may explain why, despite the dramatic announcement, the market's immediate reaction was measured rather than panicked. Financial markets often respond not only to policy actions but also to the credibility and perceived resilience of institutions designed to maintain stability over the long term. The episode also underscores the interconnectedness of global financial systems. Movements in the US dollar affect everything from international trade to commodity prices and emerging market debt. A weaker dollar can boost exports by making American goods more competitive, but it can also increase costs for US consumers buying imported goods. Simultaneously, currency fluctuations reverberate across international capital markets, influencing interest rates, bond yields, and investment flows worldwide. In this context, any action perceived as undermining the independence of the Federal Reserve can have consequences far beyond Washington, extending to Europe, Asia, and emerging markets. Investor sentiment continues to be shaped by a delicate mix of domestic economic data, political developments, and expectations for central bank policy. The market's muted reaction to Cook's dismissal suggests that investors are attempting to balance caution with the potential opportunities arising from a more dovish Fed. At the same time, ongoing global uncertainties, including political fragility in Europe and uneven growth in Asia, limit alternative hedging options, creating a complex environment for portfolio management and currency trading. Ultimately, the dollar's trajectory will depend on several key factors: the legal outcome of Cook's dismissal, the Federal Reserve's policy actions in response to economic signals and political pressure, and broader geopolitical developments that influence global risk sentiment. For now, traders and investors are navigating a highly fluid situation where the traditional principles of central bank independence intersect with real-time political maneuvering, creating a volatile environment with implications for currencies, interest rates, and global financial